To eat their lunch, I want to take this opportunity to introduce our keynote luncheon speaker. It's my honor to introduce him. George Cooke holds a Bachelor of Arts in Political Science and an MBA from Queen's, an honorary Doctor of Laws from Assumption University in Windsor. He was the general manager of the Ontario Automobile Insurance Board from '88 to '89, was a special advisor of policy to the Deputy Premier and Treasurer from '89 to '90, and worked as an outside consultant to the government from 1990 to 1992. That's right in the heart of the no-fault era. He joined Dominion of Canada as its president from 1992 to 2012 and continued as a director for another year thereafter. He was a director of the Insurance Bureau of Canada from 1992 to 2013, director of the Facility Association from 1992 to 2010, director of Property and Casualty Insurance Compensation Corporation, which we know to be PASIC, from 1997 to 2012, was the chairman of the board of Canadian National Insurance Crime Service, CANATICS, which is 9 member companies representing about 75% of the auto business in Canada, from 2013 to just about a month ago. Prior to that was a member of the steering committee of Ontario's Auto Insurance Anti-Fraud Task Force in 2011 and 2012, which you'll recall led to some of the product changes that happened around that time. He's a past director of the Toronto Rehab Institute for 6 years. He is currently the chairman of the board for the Ontario Lottery and Gaming Corporation, and no, he can't get you the winning ticket just by asking him, and of the Ontario Municipal Employee Retirement System, OMERS, which is Canada's largest pension fund, and he's a member of the board of Hydro One. All I know is that George has cost me a lot of money since I first met him over 20 years ago. I first met George when I was sitting in a round table chaired by the superintendent of insurance, who at the time I think was Dina Pelosi, with a bunch of other CEOs. I was pretty green still and not out 10 years, but that didn't stop me from speaking my mind, one of my endearing traits, I'm told. George was then president and CEO of Dominion and came up to me after the meeting and said he wanted to get to know me better. Talk about an exciting moment to be approached by the president and CEO of a major Canadian insurer for whom we didn't yet do any work for as a firm. George asked me if I wanted to join him for a round of golf. I had to tell George that I didn't golf. We never did have that meeting to get to know each other at that time. Instead, after kicking myself all the way home, I embarked on a new challenge, learning to golf. I figured between clubs, lessons, green fees, lots and lots and lots of golf balls, golf trips, membership in the golf course, George has cost me well north of $200,000. We did get that round together many years later, and we've kept up over the years. There's probably no one with more direct insight into how the insurance product has evolved over the past 30 years and who has led the charge towards change of this product than George Cooke. We are thrilled that he is here to share some of his insights with us today.
Good afternoon, and Eric, thank you very much for a rather lengthy introduction, and in my retired wisdom, it doesn't get much better than this, so I should likely leave now, but that's not what you asked me to do. So I've been gone from the industry, effectively gone from the Dominion for about 4.5 years, and it is somewhat intimidating to look out at a crowd like this and I actually think that you might have some wisdom to impart through a luncheon speech when you're that far out of date, or put differently, you know, as you're shopping in your local Loblaw store looking for your President's Choice Auto or whatever the case might be. Most of these things have a best before date on them. So I'm hoping I haven't gone past mine, and you'll find that some of my observations have some relevance. What Eric's asked me to do is briefly look back a little bit over the past few decades on the auto insurance piece, but more importantly, try to offer some thought about some of the transformative change that might otherwise take place over the period going forward, and to talk a little bit about what some of the causes of that change, talk about some of the causes of that change could be. And in that regard, just looking back for context, I got into this business back in the late 80s. We just survived a liability crisis. Coulter Osborne had just completed his study. There was a tremendous amount of wisdom in that study. I think hindsight, looking back, would say that people should have paid more attention to that document than they did. But nonetheless, shortly thereafter, through the midst of an election campaign, we embarked on a newfound hybrid of tort and no-fault considerations, and then lived through roughly 2.5 decades, I guess, of sort of modifications to that basic approach. At any point in time, there was a little more of this or a little less of that. People tried to reconfigure different product offerings. They wrote new rules trying to deter certain forms of behavior. But for all intents and purposes, nobody has stepped back and said, let's start over again. Let's go back and try to understand what it is we're really trying to do here. Let's go back and say, someone's going to be injured in an automobile accident. How do they need to be treated? Who's going to do it, etc. It's basically been a series of adjustments made to what arguably could have been a flawed approach in the first place. In that period, we had a challenge as to who should own the system. That was part of how I ended up getting to the Dominion. The NDP, of course, wanted to nationalize the industry. They didn't, thank God. But part of the consequence of backing off was a whole new approach to the way in which benefits to injured people would get delivered. And so it's been a very interesting period. And one would have to say about every several years we've had change. The kind of change that we're going to see going forward, I'm going to try to make the case to you today, is going to be quite different than that kind of change that we've seen. And the kind of change that we'll see going forward, certainly in the short term, let's just say next 5 years, likely in the period for the next 5 years after that, is going to be driven by, I think, depending on how you want to count it, either 3 or 4 factors. One of those is going to be technology, and if you want to couple with that advanced analytics, because one does somewhat enable the other, that is going to be a source of change in our sector. A second will be the introduction here in Ontario of a different approach to regulation, and that will have derived from the governance study that was done looking at FSCO and having recommended a new financial services regulatory agency. And I'll come back and talk a little bit about that in a minute as well. And then the third catalyst for some fairly dramatic change, I think, will be the Marshall Report. And I understand that you spent some time this morning looking at 9 or 10 of the recommendations in that report. But very clearly, David Marshall, who, if you don't know what his background is, a former deputy minister in the federal government, a former CEO of the WSIB, now an advisor of a number of different files to the government, prepared a pretty comprehensive set of recommendations that have gone forward to the government and were made public only in the last few weeks or so. So I want to start there, if I may, and I'm not going to repeat what you did this morning, but if I can find my glasses someplace here, I'm going to read to you a couple of the starting conclusions that he made. So just bear with me while I search endlessly. Did I leave them on the table? No, got them. Here they are. See, it's the joys of being older, gray hair and old. I'm not going to read extensively, but I want to pick out 4 bullet points that really capture what his starting point for his analysis is, and they in and of themselves, I think, will help us understand that the type of change that might be coming as a result of this particular initiative will be different than the ad hoc type of change that we've seen over the past few decades. And I'm quoting from him. The system allows participants to work at cross purposes to its original goals. Bullet point 1, insurers do not aim to provide care to their customers, rather they focus on controlling costs. Second point, accident victims may seek to maximize their entitlement rather than address their need. Third point, lawyers working on contingency fees work to boost the value of claims. And 4, providers are paid on volume of treatments, not results. Now, he goes on in his report and he makes any number of recommendations. You can, if you want to find this thing, it's on the Ministry of Finance website. You can break it down into 4 or 5 categories of recommendations, or you can likely look at about 40 some odd recommendations that are in the report. But basically what he's describing here is a broken system, and he's taking a step back, not one that recommends incrementalism, but one that really advocates pretty fundamental change to the system. And what's most interesting is no reduction in benefits. This isn't the exercise of saying so-and-so is getting too much, I'm going to take some care away. If anything, I think implicit in here is likely an increased quantum of injury cost, if you will, for somebody that's catastrophically injured. He doesn't come right out in the report and say that he thinks that the current levels of compensation are inadequate, but if you sort of look through the kinds of recommendations he talks about with his programs of care and the fact that he talks about continuing care over a lifetime for certain types of injury, and you imagine what those costs might be, he's actually in many instances, I think here around that particular catastrophic injury type, advocating an increased level of compensation for those types of injury. That is going to be a very interesting discussion that will be held over the next coming months. Now what's interesting here is that we've got an election just about a year from now. And the kinds of changes that David's talking about, I think, are very hard to implement in a quick way. There's no sort of easy win here that politicians will actually gravitate towards. He's talking about fundamental system change. The only quick win I see in here that might happen actually relates to contingency fees. And I note, as some of you may be aware, you may not be, there's a private member's bill in the legislature at the moment trying to do something about the contingency fee that I think has largely come out of the Diamond and Diamond articles in the Toronto Star. It should have come out of something a long time ago, but that having been said, sometimes the media actually do play a role in terms of giving people some impetus towards some form of change. So the timing of this report is interesting, but I suggest to you that it has, it's incredibly well written, and I think it will have an appeal regardless of which political outcome takes place a year from now when the election is held in June. So people should not ignore this work, and I think, quite honestly, over the coming months, you'll find that in different forums, either you or the people you work with will be asked to engage in talking about some of these recommendations. I think you should take that seriously. There is an opportunity here for transformative change. In terms of FSRA, I was one of a panel of 3 that was asked by the Minister of Finance just about 2 years ago to do what in essence was a governance study on fiscal, and to come back to the government and offer some advice as to whether or not fiscal was doing what it was supposed to be doing, and for that matter, whether what it was supposed to be doing was consistent with what the government wanted it to do or what the government should want it to do. And the consequence of that work, and I've simplified there's about 5 pages that describe what I just said in about 3 sentences, but the essence of what we did was we said, no, this isn't working the way that it should be. And you've got to realize that fiscal is not just auto insurance. It's got licensing of insurance agents, it's got mortgage brokers, it's got cooperatives, it's got credit unions, it's got all kinds of things that are all bundled in there in financial services. And that regulatory structure, particularly in the context, if you look forward into the future and you see the OSC, the Securities Commission rolling into the National Securities Regulator of some form, the FSCO or FSRA as it now will be, likely becomes the preeminent regulator of financial services here in Ontario. And so we made a lot of recommendations in it, but some that are perhaps of more significance to this particular crowd were that this thing needed to be arm's length from government. It should be separate. It should be driven by a skills-based board. It should have independent from government. That board would have rulemaking authority. In other words, you don't have to go back to the government every time to make changes to the way certain things are done. The OSC has worked like this for the last couple of decades. It allows for both a period of consultation, but it allows for a timely response to changes in the environment. There were a number of governance suggestions like that were made, but perhaps one of the more important ones was the fact that the mandate that we're suggesting that govern the behavior of this beast be broadened, include a balancing of the interests of consumers and commercial activities that are engaged in the space, explicit recognition there for the encouragement, the development of technology. As an example, specifically encourage, empower certain behaviors with respect to fraud, thinking in particular of, as we did, of insurance or mortgage fraud. And so it's actually quite a different approach to regulation. When it came to the whole question of auto rate setting, that actually wasn't in our mandate, because we were looking at the actual fiscal legislation as opposed to the legislation that is around it, that it actually effectively operates. And so we didn't have a chance to get at benefit levels, for example. We didn't have a chance to get directly at the whole exercise of price setting. But what we did do was basically give notice through our consultation exercise that there was an issue that many of the people that were regulated by FSCO saw with the dominance and distraction that auto insurance caused. So when you talk to the people that were doing mortgages or doing cooperatives or doing credit unions, one of the bitches that they had was that the people couldn't pay enough attention to them because they were always fighting fires in auto insurance. And when you talk to the auto insurance folk, they were arguably often saying, we're getting way more attention than any rational approach to this sector would ever want us to get. And so we were able to go, if you will, through the side window or the back door and offer some comments around auto insurance regulation that ultimately I think will be quite transformative again in terms of the way in which that sector is regulated. And among other things, what we ended up recommending was that the actual approach to the regulation of the auto sector be determined by FSRA, that FSRA be given a broad mandate, so there's a constraint around what it is supposed to be doing, but leave it to the board to figure out how to do it. And if that particular recommendation is accepted, then that opens the door, I think, to logically inclined, informed individuals to radically change the way in which this sector is regulated. So FSRA is real. The enabling legislation was passed before Christmas. There was reference made to it in the spring budget that, among other things, says look for more legislation to implement this beast in the fall. It also gives rise to the likely appointment of the first board of directors sometime this spring, translate somewhere around the 1st of June most likely. And my hope is that you'll see, I call it, it'll be the first board, but it likely will have fewer directors on it than you would expect on the final product. and those folks will be engaged in an exercise of basically building the new regulator before the old regulator is taken apart. So one of the very clear transitional recommendations we had was don't fix what's there, start over, and once you've built your new house, move into it, but don't try to move in while the construction's still going on, if I can use that type of a simplistic analogy. So that's coming, and that's going to change the way you guys do business in some form or another. And then, of course, we have this whole issue of analytics, and we have the issue of technology and how the two combine. I can go down a couple of different avenues, but CANATICS, which I just resigned as the chair as of April 1st, not because of anything wrong with CANATICS, but there's some pretty advanced world-class analytics that have been developed there. Whether we all know and appreciate it the way we should, the ability through the exercises that CANATICS undertakes to identify those claims that are more likely to be fraudulent than those that aren't is sophisticated in a world-class level. And that's alive and well. And the industry will, I think, over the course of the next few years, have to figure out just exactly what role it chooses to play in fraud, and whether certain things are left to companies, whether certain things are done through associations, whether how that whole approach sorts out. There's a work group that maybe some of you are part of that's being led by the Insurance Bureau of Canada at the moment. CANATICS is certainly well represented there. One of my former colleagues on the board is chairing it. I think it could be also quite transformative in terms of the way the industry, with the existing tools, looks at fraud. That should have some impact on your lives. And then we get into the whole technology space, and it starts to tie back to some of these other areas. But if we talk, 4 years ago, if I talked to somebody about the connected car, most of you would have thought that I was back watching the Jetsons or something. In fact, I did that on a panel at an insurance congress, and I became George Jetson instead of Cooke for the rest of the day because I was chatting about the connected car. But today we know that's not a fantasy. That's something that's actually real. It won't be that long before cars are driving themselves, and they're talking to roads, and they're talking to road signs, and they're talking to traffic lights, and they're talking to, so the parking meters won't exist, of course, because the car will know where it's to park or it's not to park, and what the fine is it'll have to pay, and it'll pay it itself, and all those jobs will change. And you say it lightheartedly, but that's exactly right. And if you take that back into the whole issue of a collision, assuming that these cars actually collide, and inevitably they will because something will go wrong, but presumably they will collide less often, and presumably the injuries that will take place when that happens will be less. They'll actually tell you how the event happened. They'll tell you how the collision happened, who was at fault and who wasn't, and what it means. It's going to change. That technology and that innovation is going to change the nature of the business that I was in for 2 decades, and all of you are currently still engaged in. And that will be very, very interesting. We're not going to go from A to B overnight, and we can have a discussion likely whether it's 5 years, 10 years, 15 years, 20 years, but it's some number of years, and it will happen. Just to give you a sense, and this point doesn't prove anything, but Volvo has as I understand it, a global initiative that whether they'll ever meet it or not, but the goal that actually was adopted by their board internationally was that nobody would die in a Volvo beyond 2019. Now that's pretty ambitious, but people actually look at that today as being credible, as opposed to the way they might have looked at it only 5 years ago as being a piece of fantasy. Here, I'm told that the guidelines that Fiscal currently has that were restricting the use of telematics data in claims issues have been altered. I don't know whether that's true or not. I haven't seen the new guidelines, but for the longest period of time, as people were trying to introduce telematics into vehicles, the focus was on how large a discount I can get, as opposed to how high a surcharge might be, how I would pay, or how you could take this information to actually improve driver safety or driver skill sets. But from a claims point of view, it wasn't going anywhere because there were regulations in place that were prohibiting it to be used in claims. That will change very explicitly when the new regulator comes. This aspect of technology will be welcomed, encouraged. The mandate of that organization will be such to make sure that it happens rather than to impede its progress. They'll be forced to engage in the management of it, but they will not be permitted, if you will, to stand in its way. Just think about what that might do to the way in which you actually conduct work. And I suspect if I try to tie this back to where Marshall is with his recommendations, if you look at it, you'll find there's a whole section in his report highlighting, this is my take on it at least, highlighting the advance that's available to help consumers through technology and welcoming the fact that there'll be an independent expert board that will be engaged in seeing how that is done. He's actually tied those sorts of observations back into the work that the panel that I was on did in terms of the governance situation with FSRA. So what does that mean? So for me, being a 64-year-old retired guy that is fundamentally these days doing board governance work and occasionally having his arm twisted by old friends to come and talk to luncheon crowds without prepared text, what that means for me is I more than ever wish I was 50 years old again instead of 64, because I think living through this period would be absolutely fascinating. But there are going to be some people that likely don't share that view. People will find it maybe quite fearful. They'll be very fearful of what's lying ahead. What I suggest to you is that this change will happen. And I encourage you to find a way to embrace it, shape it, be part of it, take part in it, actually win with it. If you focus, I think, on what society wants as an outcome, which is, among other things, I think, caught back in the type of mandate that we've suggested for FSRA, but it's a balance between a healthy respect for consumers and the need to have a healthy economy or healthy commercial activity as part of looking after that consumer interest. Those that manage to look at that will find both opportunity to succeed and be involved, but the way in which you do that is going to be dramatically different, I think, than the way it is today. So with those sort of general observations, Eric, I'm going to stop, but I'd be more than happy to take questions if anybody is either crazy enough or brave enough to ask. I'm more than happy to do that.
I'll ask a question. And this is not,
That's both brave and crazy, right?
it's not staged, it's not prompted. But
No.
Marshall's recommendation includes this notion of effectively casualty insurers turning into life and disability insurers for the delivery of AV product, where you're going to be managing a claim for life. As a former CEO, where you've got all kinds of staffing issues and costing issues in terms of how to run a product like that, how do you envision that to work?
As a former CEO, I'm not going to have to answer that question, actually. Let me simply say this. If those companies don't reinvent themselves that way, the alternative, I think, that sits out there, because the four observations that I read to you out of his report, I think are valid. And whereas we may not like them, if you just pause and look at them, they're not inaccurate observations that an informed guy made after pretty broad consultation around this sector. So we got a problem. So we're going to solve it one of two ways, I think. The third way would be for the government to take it over, which would be an absolute bloody disaster. So I didn't like that when the NDP tried it years ago. I'll never endorse, government doing those sorts of things. So you got two buckets of choice coming out. You either have the existing companies reinvent themselves, or what you'll end up seeing is and in that context, you'll have your prescribed programs of delivery that he talks about, and you'll have your adjudication effectively being done most probably by publicly funded institutions called hospitals, etc. That sort of exercise. And then people will live with the determinations. And the fact that WSIB works somewhat like that shouldn't surprise anybody in terms of his own background. The alternative to that, I think, is that a product that's not unlike our current product gets unbundled completely. And when I say that, you as a consumer likely get told there's a prescription that says, I want you to carry so much coverage for these sorts of things. But if you already have a disability product, or you choose to buy it from somebody else, or you choose to have more coverage rather than what's prescribed, you wouldn't necessarily have to purchase that from the same entity that you actually purchased the sheet metal and tin coverage from, or you purchased the life insurance component from, or whatever the case may be. But I think inevitably what's happening here is that there will be a consensus around the fact that there's a problem, which I think he's defined well, and then you got to go and solve it. And the existing, from a company perspective, the existing delivery of a bundled product put together the way it is isn't going to work. You're never going to get the value for consumers out of that you want, and you're never going to get the cost that consumers are prepared to pay out of that working. So you're going to move down one of those two paths. You may move down both at the same time. So my answer back to you is that if I were still running a company right now, I would be actually sitting down figuring out, I don't know how to do what you've asked me to offer to you, but I'd be sitting down saying, I got to do it because otherwise I'm gone. Like this sector will change. The forces are so great, it will change. So that's my best answer to you. But there's lots of people out there that have figured out how to deliver disability products. There's no reason why those running auto insurance companies can't figure it out. It may be through partnerships, it might be through acquisition, it might be starting with a clean slate. Please. Yep, one here.
Nice to see you, George.
Nice to see you. Always nice to have a plaintiff.
One plaintiff lawyer in the room. And this is probably a rare occasion where I actually agree with you that I as well am very excited about the future and what's going to happen with technology and how it's going to make roads safer, things like that. It's a very exciting time. On the other hand, there are going to be disruptions in the industry. And I think, as much as we're embracing the future and trying to figure out how we're going to play a role if we're doing motor vehicle work or insurance work, what advice do you have with a room full of these young adjusters that are doing auto insurance if we're going to have contraction in the industry? What do you suggest to them in terms of how this is going to be 15 years from now? What kind of career advice do you pass on?
There's a toughie, but well done. I remember these conversations with another member of your family about 30 years ago, too. Yeah, right, exactly. Thank you. First of all, this change is going to happen. It's not going to happen tomorrow. So people don't have to run out and slit their throat or alternatively, seriously, or alternatively go looking for other jobs immediately. But I think you need to be prepared. You need to be prepared to at least get a grasp of what you think that new world might look like and what you think some of the skill sets that will be necessary to have employment in that space might well be. And so I look out at this room, and as I would be doing if I were still running a company with these people working in my world, and I'd be saying, you guys are educated, you're smart, you're likely good at your jobs. You're going to find a way to to come through this. But the reality is, I think, so I'm going to go down this path. On the sales side, as a result of the technology that's coming, personal lines underwriter, as we know them today, somebody that's doing the underwriting, the car's going to underwrite itself. Technology is going to do it. The person that's selling the product today, you're going to buy this insurance likely with the car, because there's going to be this little thing that I could hold in my hand in the car that's going to price it. It's going to price it. It's going to measure against the price. The price is going to change over time based on the way the vehicle is driven, and that transaction will happen when you actually purchase the vehicle. From a claims point of view, so that whole chain coming into the organization is clearly threatened. Okay, and in terms of stages, chances are the pressure point will be that those that are serving multiple markets get reduced to single markets, get reduced to not being there because technology will take its place. Similarly, on the claims side, as I suggest to you, the vehicle will actually be able to tell you that it's what's happened. And so the role of the adjuster, the role of the people that are involved in handling those claims will change. But the skill set's still going to be needed to be there. People are going to have to facilitate a whole set of new human interactions. There'll be whether as case managers, for example, it's not clear to me. I haven't been engaged to sit down and do that. From the lawyer's point of view, an interesting development in Europe at the moment as they're thinking about this. There's a movement afoot to actually say, you know what, we're still gonna hold the vehicle, and if there's injuries, the tort action, as the case may be, or whatever the action is, will be against the vehicle, and then the insurer of the vehicle will have to go back against the product liability folk. I don't know whether that's the approach that'll be taken here or not. Somebody's going to have to get involved and figure that out. There's a whole great set of jobs for somebody to do with the technology, but it's not clear how these things will unfold. But what is clear is that 15 years from now, people won't be doing the same things they're doing today at all. And sorry that I'm being the one to deliver that message. I don't mean to do that with enthusiasm. I reinvented myself as when I tried to retire. I found retirement rather difficult, so I found myself, sitting as a corporate director. Who would ever have thought? You people are capable and bright. You'll find things to do. So that's the best answer I can give you. Sorry. Notice I stayed away from describing what the plaintiff lawyer would do, but that's okay.
Thank you very much, George, not only for your talk, but apparently we also have to thank you for getting Eric to disappear every summer. And with that, we're going to move right into our first panel. The topic of the panel is called Embracing Change, and it's going to be addressing some of the change that we're currently facing and hear what it takes to adopt. Are you giving me a signal? Apparently dessert comes before the panel, which everyone, I'm sure, is not going to be upset to hear. So maybe I'll give it 5 minutes. I think that maybe someone is waiting in the wings to clear plates, so there's not a lot of clanking, and then we'll get going again.